This show is part of One Place, a daily network of focused briefings across the stories people follow most.
Today, we're looking at a global economy on edge as oil prices flirt with the $100 mark and stagflation fears return. We'll examine why a record release of global oil reserves hasn't calmed the markets, and what the surge in crude means for your personal finances, from petrol to mortgages. We also cover the massive toy collaboration between PopMart and Sanrio, the latest U.S. inflation data that arrived just before the war, and Elon Musk's new payments platform, X-Money. Plus, we'll analyze whether tapping into emergency oil stockpiles actually works, the UK's role in the latest IEA release, Sam Altman's warnings about AI's popularity, and the fierce rivalry between AI startups Harvey and Legora.
We start with the deteriorating situation in the Middle East and its immediate impact on the business world. The global economy is facing what experts call a broader stagflationary shock as the conflict involving Iran escalates. Brent crude has hit that psychological $100 a barrel threshold again after two tankers were set ablaze in Iraqi waters. It's a grim picture. Iranian officials are warning of a long war of attrition, and we're seeing reports that Oman's key oil export terminal has been evacuated. This isn't just about high prices at the pump. It's about the risk of stagnant growth paired with rising inflation, which is the definition of stagflation. Investors are now pricing in a much more protracted conflict than they initially hoped for.
And while the West worries about stagflation, Russia seems to be cashing in. Reports show that Russia has pocketed roughly €6 billion in fossil fuel revenues since this conflict began less than 2 weeks ago. They are earning about €510 million a day, which is 14% higher than February levels. It really highlights the harsh reality of fossil fuel geopolitics. When the Middle East is in turmoil, other authoritarian exporters see their profits soar. This surge is also hitting other commodities. Aluminum prices are at their highest since 2002 because the Strait of Hormuz is effectively shut, and that region accounts for 9% of global aluminum output.
Now let's look at the global effort to stabilize these volatile energy markets. Despite a massive record-breaking deal to release 400 million barrels of oil reserves, prices are still surging. The International Energy Agency, or IEA, moved to boost worldwide reserves in the largest release in its 50-year history. But the market isn't biting. Brent crude rose another 4% on Thursday morning. The problem is that while the IEA is pumping supply into the system, Iran is continuing to strike key energy and shipping infrastructure. 3 more cargo vessels were hit in the Gulf recently, and with the Strait of Hormuz halted, a route that carries a fifth of the world's oil, the physical disruption is just too large for reserves to fully offset.
It's a nightmare scenario for investors because it confirms that one of the world's most vital waterways is essentially closed. We're seeing stock markets tumble globally, with the FTSE 100 in London and major indices in France and Germany all sliding. Analysts are pointing out that these emergency measures might actually be sending a hidden negative signal. By releasing such a huge amount of oil, world leaders are signaling that they don't see a quick path to de-escalation. It suggests that the supply shock could be much more permanent than we'd like to believe, keeping a permanent bid under oil prices until a ceasefire is actually in sight.
Next, let's break down what this actually means for the money in your pocket. The impact on personal finances is becoming very real, very fast. In the UK, petrol prices have already jumped by up to 8 pence per litre, hitting 20-month highs. But it's not just the car. Heating oil costs have already doubled. The real concern is persistence, not the peak. If oil stays high, those costs feed into everything: manufacturing, food, and transport. We're also seeing a direct hit to the housing market. Because high oil prices drive inflation, the Bank of England might have to keep interest rates higher for longer. We've already seen lenders like NatWest, HSBC, and Santander raise rates on new fixed-term mortgages just in the past week, as they anticipate this shift.
It's a double-edged sword, though, because while debt gets more expensive, savers might finally see some better deals. Banks are starting to offer more competitive rates on easy-access accounts and ISAs. However, for those with stock market investments or pensions, the advice is generally to stay calm. The FTSE 100 fell more than 5% last week, but selling during a dip often just locks in those losses. The bigger picture here is that the conflict has essentially derailed the UK's path back to a 2% inflation target. Analysts had hoped we'd hit that target by early spring, but with energy and food costs rising, that timeline is now very much in question.
Moving away from the energy crisis for a moment, there's a massive story in the world of retail and collectibles. Pop Mart and Sanrio are joining forces in a collaboration that's expected to set the toy world on fire. Pop Mart's iconic Labubu doll is getting a Hello Kitty makeover, along with other characters like Cinnamoroll and Kuromi. This is a huge deal because both brands have massive, dedicated fan bases. They're using the blind box model, where you buy a box without knowing which character is inside, which creates this sense of a gamble that collectors love. These 7-inch keychains are priced at about $40, but the collection also includes 15-inch plush dolls for nearly $150. It's all launching online this Thursday.
What's really interesting here is the focus on kidults, adult collectors who buy these toys for nostalgia or emotional support. Labubu is a powerhouse for Pop Mart. It accounted for nearly half of their IP sales in the first half of last year, bringing in $700 million. Analysts think this partnership is a win-win because it introduces each brand's fans to the other. We've seen in the past that Labubu launches can cause actual chaos in physical stores, with products selling out instantly. By shifting the initial launch online, they're trying to manage that demand, but it's clear that the blind box craze is only getting bigger as these two giants pool their resources.
Now, let's pivot back to the economy and look at the most recent inflation data from the U.S. The February Consumer Price Index report was a bit of a calm before the storm. Inflation held steady at an annual rate of 2.4%, which was actually slightly cooler than economists expected. But there's a huge catch. This data captures the period before the Iran war broke out. Since late February, gas prices have surged by about 60 cents a gallon, or 20%. So, while the February numbers look decent, they are essentially stale. Economists are warning that the progress we made in taming inflation is likely to be erased in the March and April reports, as those higher energy costs bleed into the rest of the economy.
This really changes the calculus for the Federal Reserve. Before the conflict, markets were hoping for rate cuts fairly soon, but now it looks like the Fed will be on hold for much longer. They need to see if these energy price spikes become embedded in the economy. It's not just gas, because the Strait of Hormuz is a choke point for fertilizer. Food prices are expected to climb as well. Even though the economy lost 92,000 jobs last month, which usually argues for a rate cut, the fear of a new inflation surge means the Fed has to remain cautious. Investors are now looking at July or even September for the earliest possible rate cut.
Let's shift gears to a major development in the tech and payment space from Elon Musk. Elon Musk is preparing to launch X-Money, his new digital payments platform, in beta this April. It's being described as a key part of his everything app vision, similar to China's WeChat. The idea is that X-Money will handle peer-to-peer transactions, much like PayPal or Venmo, but integrated directly into the X social media platform. Users will be able to fund a digital wallet through a partnership with Visa and make direct payments to others. We even saw William Shatner teasing the launch recently, offering beta invitations in exchange for charitable donations. Musk has said he wants this to be the place where all the money is, which is a bold goal even for him.
However, it's not all smooth sailing. While X-Money is licensed in 40 states, New York officials are actively trying to block it. They've expressed concerns about Musk's pattern of reckless conduct and whether the app will actually protect consumers. It's a fiercely competitive space, but some analysts aren't counting Musk out. He does have a deep history here. Don't forget he co-founded X.com back in the 90s, which eventually became PayPal. If he can leverage the existing user base of X and integrate generative AI into the commerce side of the app, he might actually have a shot at disrupting the digital wallet market, despite the regulatory pushback.
Now, let's go deeper into the mechanics of those oil reserves we mentioned earlier. There's a real debate right now about whether releasing millions of barrels from stockpiles actually works. The IEA was created after the 1970s oil crisis, specifically to handle these shocks, but this is only the 5th time in history they've hit the emergency button. The current release of 400 million barrels is massive, but critics point out a huge math problem. Shutting down the Strait of Hormuz cuts off about 10 million barrels of supply per day. The largest past IEA release only managed to put about 2.5 million barrels a day into the market. There's also the physical limit of pipeline capacity. You can only move the oil as fast as the infrastructure allows.
Exactly. And there's the psychological factor to consider. Some experts argue that these reserves are more of a symbol than a solution. If you use them up too early in a long conflict, you lose your leverage. Also, while we have these strategic reserves for oil, there's no equivalent for natural gas, which is also under immense pressure. In the UK, there's even quiet talk about the potential for energy rationing if the crisis drags on. The IEA release might shave $10 or $20 off the price per barrel in the short term, but if Iran's threats of $200 oil come true, these reserves are just a drop in the bucket.
Let's look more closely at the specific international agreement led by the IEA. The IEA's decision to release a third of its total emergency stockpile is a historic intervention. The UK is playing a significant role here, contributing 13.5 million barrels from its own reserves. Energy Secretary Ed Miliband has been vocal about this, stating that while the UK has diverse energy supplies, the real solution is to end the dependency on global fossil fuel markets entirely. He's pushing for a shift to clean, homegrown power that the country can actually control. It's a sentiment shared by many G7 finance ministers who are trying to coordinate this release to prevent a total economic meltdown. But they all acknowledge that getting tankers back through the Strait of Hormuz is the only real fix.
It's interesting to see how this affects the big oil companies, too. Majors like BP and Shell have seen their stock prices benefit from the price spike, but a massive reserve release could force them to give back some of those gains. The UK government is stressing that they are working with international allies to address the market disruption, but the price cap on energy bills in the UK only protects consumers until July. After that, if the IEA's move hasn't stabilized the market, families could face a massive jump in their utility costs. It really highlights how vulnerable the global north still is to these supply chain choke points.
Switching back to technology, OpenAI's Sam Altman has some surprising things to say about the public's view of AI. Sam Altman recently admitted that AI is not very popular in the US right now. He's seeing a lot of political and social headwinds. People are blaming AI for everything from rising electricity prices to the recent wave of corporate layoffs. Altman says AI has become a convenient boogeyman. Polling actually backs him up. 57% of voters in a recent NBC News poll said the risks of AI outweigh the benefits. That's a significant shift in public sentiment, and Altman is worried that if the US doesn't embrace AI adoption quickly, it will lose its competitive edge against countries like China.
There's also a lot of tension regarding the power balance between AI companies and the government. OpenAI recently signed a deal with the Pentagon, which has raised some eyebrows, especially after the Defense Department effectively blacklisted their rival, Anthropic. Altman argues that while companies play a role, the government needs to be able to depend on them. He sees AI as a wealth fountain that could rewrite the rules of society for the better, but only if we can navigate these supply chain issues and public skepticism. It's a high-stakes race, and he's basically saying that the U.S. lead is far from guaranteed if the public remains this concerned.
Finally, let's look at the Coke and Pepsi rivalry unfolding in the world of legal AI. In the world of big law, two startups, Harvey and Legora, are locked in a fierce battle to become the primary AI tool for lawyers. Legora just raised $550 million, valuing the company at $5.5 billion. Its founder, Max Junstrand, is only 26 and has no legal training, but he's been incredibly aggressive in challenging Harvey's early dominance. Harvey currently has more than half of the top 100 U.S. law firms as customers, while Legora has about 20%. It's a high-stakes proxy war for how quickly AI can disrupt one of the most conservative industries in the world, an industry that hit $1 trillion in revenue last year.
What's fascinating is the cultural clash here. Lawyers have traditionally relied on the billable hour, so software that makes them more efficient could actually shrink their revenue. But top-tier firms are realizing that if they don't use these tools to do routine work faster and cheaper, their clients will just go elsewhere. Junstrand is betting that he can out-execute Harvey by building a better product, even if they weren't first to market. He even stopped all sales for 6 months just to refine the code. It's a classic Silicon Valley rivalry, with board members trading barbs online and law firms hedging their bets by buying licenses for both platforms just to see who comes out on top.
That's all for today's roundup. It's a lot to process, from the global energy markets to the future of how we work and pay for things.
We'll be back tomorrow to see how these stories develop. Make sure to follow us to stay informed on the latest briefings. Thanks for listening.